Most financial mistakes are recoverable. You can pay off the debt, you can rebuild the savings, you can restart the investment account. Most of what goes wrong in personal finance has a correction available. Expensive, sometimes, but available. There is one mistake that is structurally different from all the others. Not because it's dramatic, not because it destroys in a single transaction, but because it operates as a strategy, a complete, internally coherent approach to money that produces real results, just not the ones the person using it intended. The strategy is optimizing for looking wealthy. And the reason it's structurally different from other mistakes is this. It is the direct opposite of the strategy that actually builds wealth. Not a detour, not a delay, the opposite. The two strategies compete for the same resources, the same dollars, the same decisions, the same finite allocation of attention, and every unit that goes to one is a unit that cannot go to the other. This is not a moral argument. It is not a judgment about lifestyle or values or what someone deserves. It is a mathematical observation about the direction of resource flow. And the mathematics, once laid out clearly, make the case more thoroughly than any moral argument could. Here is what the two strategies actually look like and why they cannot coexist. Part 1. The allocation cannot go both directions. Every financial decision is a binary allocation. A dollar spent on something visible, a car payment, a status upgrade, a lifestyle signal, is a dollar that cannot compound in an investment account. This is not a complicated insight. It is arithmetic. What makes it significant is how consistently people underestimate its cumulative consequence. Consider two people. Same income, same starting point, same year they decide to get serious about money. One person allocates $800 per month toward visible lifestyle, a newer car, a better apartment than necessary, the restaurant that matches the professional image, the wardrobe that communicates success. The other allocates that same $800 per month into a low-cost index fund. After 5 years, the difference looks manageable. After 10 years, it becomes uncomfortable. After 25 years, at a 7% average annual return, the investment account holds approximately $650,000 that the other person's visible lifestyle consumed. Not $650,000 spent on one decision. $650,000 consumed by a consistent pattern of small, individually reasonable allocations, each of which looked like a normal expenditure and functioned as a permanent transfer away from the compounding side of the equation. The person optimizing for visible wealth made a series of reasonable choices. The person optimizing for actual wealth made a series of boring ones. The boring ones compounded. The reasonable ones didn't. This is the first structural difference between the two strategies. The allocation runs in one direction or the other. It cannot run both ways simultaneously. Part 2. One strategy compounds, the other consumes. The mathematics of compounding are well understood in the context of investment accounts. What is less discussed is that the same mathematics apply, in reverse, to the strategy of visible wealth. Visible wealth is not a stable equilibrium. It is an escalating commitment. The Diderot Effect, documented in academic literature since 1765 and confirmed repeatedly in behavioral economics research, describes the mechanism precisely. A visible upgrade establishes a new reference point. The new reference point creates inconsistencies in the surrounding lifestyle. Each inconsistency generates pressure to resolve it with another upgrade. Each upgrade raises the reference point again. The cascade runs continuously, accelerating over time, consuming an increasing share of available income to maintain a standard that keeps moving upward. This is the compounding of consumption. It runs on the same mathematical structure as the compounding of investment, exponential rather than linear, accelerating rather than stable, but in the opposite direction. Meanwhile, the investment account compounds in the other direction. The returns generate returns. The base grows. The same percentage applied to a larger number produces a larger absolute gain. After enough time, the gap between the two strategies becomes so large it cannot be closed by any reasonable increase in income. Vanguard's research on long-term investor outcomes consistently finds that the primary determinant of retirement wealth is not investment selection, not market timing, not sophisticated financial strategy. It is contribution rate, sustained over time. The people who sustain high contribution rates are, almost without exception, the people whose lifestyle expenses are structurally contained, not because they deprive themselves, but because they never allowed the visible wealth escalation to begin. The compounding side builds continuously. The consumption side escalates continuously. After 25 years, these two trajectories are not in the same conversation. Part 3. Visibility is a force that works against accumulation. This is the mechanism that most financial analysis misses entirely, because it operates in the social environment rather than in the account statement. When someone publicly establishes a financial identity, through visible upgrades, through social disclosure, through the accumulated signals of a successful lifestyle, they activate a set of social forces that work consistently and predictably against the accumulation side of the equation. The research is specific. Princeton and University of Chicago researchers studying identity-consistent spending found that people who establish a visible financial standard unconsciously begin filtering every subsequent spending decision through a single question. Does this match who I said I am? The filter runs below conscious awareness. It costs, conservatively, $400 to $800 per month in above-baseline spending. Over 30 years, that number compounds to between $350,000 and $700,000 in foregone wealth. This is not the cost of the visible lifestyle itself. This is the maintenance cost of the identity the visible lifestyle created. The social environment saw the reference point, calibrated to it, and now applies continuous pressure to maintain it. Every time the person tries to spend less, the gap between their behavior and their established identity creates friction. Social friction, internal friction, the friction of appearing to have fallen backward from a standard people around them have internalized as normal. The person who never established the visible standard doesn't pay this tax. Not because they're disciplined, because the social enforcement mechanism has nothing to enforce. There's no identity to maintain. There's no gap to close. The friction doesn't exist because the reference point was never set. This is the social physics of visible versus invisible wealth. Visibility generates forces. Those forces work against accumulation. The more visible the financial identity, the stronger the forces, and the harder it becomes to redirect resources toward building something durable. Howard Marks described the underlying principle. The structural advantage in any financial decision belongs to the party with the most options and the least visible need. Visible wealth signals need. Need for validation, need for social position, need to maintain a standard. Invisible wealth accumulates options. The two positions are not symmetrical. One expands over time, the other constrains. The two trajectories, 25 years later. Here is what the mathematics produce. Two people. Same income, $75,000 per year. Same starting point, age 28, minimal savings, beginning to make real financial decisions. One optimizes for looking successful. One optimizes for building something. Person A allocates $1,000 per month toward visible lifestyle signals. The car that matches the income, the apartment that communicates arrival, the wardrobe and restaurants and vacations that build and maintain the financial identity. They also establish a visible financial standard that generates $500 per month in identity maintenance costs, the slightly nicer version of everything that now feels required. Total visible allocation, $1,500 per month. Person B allocates $1,000 per month into a diversified index fund portfolio. No visible financial identity established. No identity maintenance cost. Total investment allocation, $1,000 per month. At age 53, 25 years later, Person A has a lifestyle that looks successful, a car that signals it, an apartment that implies it, a social reputation built around it, and a retirement account that reflects 25 years of inconsistent contributions made from whatever remained after the visible strategy consumed its share. Person B has an investment portfolio worth approximately $810,000. Not from exceptional decisions, not from sophisticated strategy, from the mechanical application of a boring allocation, sustained for 25 years, while the social environment never had a reference point to calibrate against and enforce. The gap between these two people is not primarily a function of discipline. It's a function of direction. One strategy directed resources toward compounding. The other directed them toward consumption and maintenance. The strategies are not both trying to build the same thing and succeeding to different degrees. They're building different things entirely. Looking wealthy builds an identity. Building wealth builds a portfolio. The identity requires continuous maintenance and escalating investment to preserve. The portfolio requires only that the allocation continues, and then it grows on its own. The reason these two strategies are opposite is not philosophical, it is mechanical. The same resource, a dollar, a decision, a unit of attention, can serve one or the other. The direction it travels determines, over time, which outcome it produces. Most people choose a mixture. They intend to split the resource. What they find over time is that the visible strategy has a gravity that the invisible strategy lacks. Because visibility generates social enforcement, while invisibility generates none. The mixture gradually shifts toward the visible side. The compounding slows. The identity maintenance grows. The people who end up with something real at the end of a long enough timeline are almost always the ones who understood this early enough to choose a direction, and then let the mathematics run. The mathematics are patient. They don't need anyone to notice. They just compound in whichever direction they were aimed.